Welcome back. I'm Darlisa Cooper, and today we are breaking down mortgage products, features, and industry standards. Misunderstanding how these loan mechanics operate carries severe penalties. In the short term, it means failing your SAFE Act exam. In the real world, placing a borrower in the wrong product actively drives them toward default and eventual property loss. Every mortgage product looks appealing on paper because each one is designed to solve a specific problem. The challenge for a mortgage loan originator is evaluating a borrower's exact financial profile and matching it to the mathematical reality of the loan over time. At the very center of every mortgage product is a strict trade-off between initial affordability and long-term predictability. When a product requires lower initial inputs, like a minimal down payment or a low introductory interest rate, it doesn't eliminate the cost of the loan. It mathematically transfers the future interest rate and equity risk directly onto the borrower. Because this transfer of risk can be dangerous if misunderstood, federal watchdogs require strict disclosures to prevent deceptive lending practices. Mastering origination means looking past the sales pitch. Your job is to objectively engineer the right distribution of risk between the lender and the borrower. This chart shows the baseline math of down payments on a $300,000 home. A 10% down payment results in a $270,000 loan, while putting down 20% reduces the principal to $240,000 and completely eliminates the need for private mortgage insurance, or PMI. If a buyer lacks the cash for that 20% down payment, but still wants to avoid the monthly cost of PMI, they might use a purchase money second mortgage. In this strategy, the borrower takes out a large primary first mortgage to cover most of the cost, and simultaneously takes out a smaller second loan to cover the gap. Because the second loan is subordinate, meaning it gets paid out only after the first lien in the event of default, the lender takes on higher risk. To compensate, the borrower pays a higher interest rate on that second loan and faces tighter scrutiny on their combined loan-to-value ratio. Minimizing upfront cash always comes with a trade-off. You either pay the ongoing cost of mortgage insurance, or you take on the structural complexity and higher interest rates of a subordinate loan. For absolute predictability, borrowers look to the 30-year fixed-rate mortgage, where the interest rate and monthly principal and interest payments remain static for 360 months. Because the lender absorbs decades of interest rate risk, these fixed-rate loans typically come with higher initial interest rates compared to early periods of adjustable options. An adjustable rate mortgage, or ARM, approaches risk differently. It offers a lower initial introductory rate precisely because the borrower agrees to take on the market risk once that period ends. This graph tracks how an ARM calculates its future cost. It starts with the index, a benchmark interest rate tied to financial markets, like Treasury securities, that fluctuates with the broader economy. Added to that index is the margin. The margin is a fixed number of percentage points the lender sets to cover their costs and guarantee their profit. It remains constant throughout the life of the loan. The index plus the margin equals the fully indexed rate. This combined number is the mathematical reality the borrower will face once their introductory rate expires. Lenders are legally required to provide the Consumer Handbook on Adjustable Rate Mortgages, or the CHARM booklet, before taking an application. This ensures borrowers understand exactly how these future rate adjustments will impact their monthly obligations. An ARM is a highly effective tool for a borrower planning to sell or refinance quickly. However, it mathematically guarantees that the borrower absorbs all long-term market volatility if they stay. Some loan structures manipulate the amortization schedule to drastically reduce early payments. The most common example is an interest-only loan. This chart illustrates a 10-year interest-only period. For a full decade, the borrower pays zero principal. Their loan balance remains completely unchanged, meaning they build zero equity from their payments. The trade-off arrives when that introductory period ends. The entire principal must be fully amortized over the remaining compressed timeline, forcing the monthly payment to immediately and severely increase. This is known as payment shock. The balloon mortgage pushes this concept of delayed repayment to an even more extreme endpoint. These loans offer very low payments for a short term, typically 5 or 7 years, but they do not fully amortize. Instead, the borrower owes a massive lump sum payment for the remaining balance at the exact end of that term. Both interest-only and balloon products carry extreme risk without a guaranteed exit strategy. They are only appropriate for borrowers who are absolutely certain they have the assets to pay the balance, or plan to sell the property before the mathematical cliff hits. Beyond purchasing a home, MLOs also structure products designed to extract cash from an existing home's equity. A home equity line of credit, or HELOC, is an open-ended, revolving line of credit. It functions much like a large credit card secured directly by the property. A HELOC operates in two phases. During the flexible draw period, borrowers can pull funds as needed and often pay only interest. Once the strict repayment period begins, they can no longer draw funds, and variable rates apply to the principal balance, which can significantly increase their monthly obligations. A different approach is the home equity conversion mortgage, commonly known as a reverse mortgage. This option is strictly regulated and available only to borrowers aged 62 and older. This chart illustrates the defining mechanic of a reverse mortgage. The lender pays the borrower, and no monthly mortgage payments are required. However, because interest accrues without payments being made, the loan balance experiences negative amortization, steadily growing over time while equity shrinks. This accrued balance does eventually become fully due. The loan terminates and requires repayment if the borrower dies, moves out, or fails to pay their basic property taxes and homeowner's insurance. Extracting equity always introduces a new vulnerability to the homeowner's financial profile. It either brings the threat of variable repayment shock with a HELOC or the systematic depletion of estate assets through a reverse mortgage. To apply this knowledge effectively, look at this matrix: primary variables, a borrower's time horizon on the x-axis, and their cash flow need on the y-axis. Borrowers staying 10 years or more who need predictable cash flow belong in the top right. They are best protected by 30-year or 15-year fixed-rate mortgages. Borrowers who are guaranteed to move or refinance within 5 years map to the bottom left. They are mathematically suited for 5/1 ARMs or balloon mortgages to capture early savings. Older borrowers needing cash without monthly payments fit reverse mortgages, while younger borrowers who need rolling capital for renovations align with HELOCs. Never match a short-term variable product to a long-term borrower without calculating and clearly disclosing the fully indexed reality. To lock in these concepts, utilize the Safe Act exam bundle, which includes flashcards, slide decks, and audio podcasts to test your knowledge. Succeeding in the industry requires moving beyond textbook definitions. Your ultimate responsibility is to engineer the safest possible financial future for your borrower.